This chapter focuses on a particular form of debt finance, leasing. Leasing has been popular in recent sittings of this exam because it is a very popular and practical way of financing investments, particularly investments by small to medium-sized companies that will find it difficult to secure bank loans. In this chapter we will work through a discussion of leasing and also look at how it can be examined with numbers, but you're reminded that in this exam the discussion areas are at least as important as the numbers, and that's particularly the case with this chapter. In this chapter we're going to assume that we've made a decision about an investment, presumably using NPV analysis, which we're going to look at in more detail, later in the course. And that having made the decision to invest in an asset, you then start to think, well, might it be better to use a lease instead of a bank loan? Both leases and bank loans are different forms of debt finance. And in this chapter we're going to look at how to appraise that decision, looking at both financial and non-financial factors. And as we do that, we're going to be using discounting techniques, which we've referred to earlier in the course and we're going to look at later as well. So now let's focus on leasing and just go through the different types and the different sorts of numerical analysis that you might be expected to perform. Okay, before we get into the detail, let's just recap on some of the basic terminology associated with leasing that you will have come across before. First of all, the lessor. The lessor is the party that's renting out the asset and receiving lease payments. And the R at the end of lessor can help you remember this, the R for receiving. And then the lessee is the party that's making the lease payments. In this exam you don't have to learn the accounting standards definitions for operating and finance leases, but you will be expected to appreciate that if you're leasing an asset, like an aircraft for example, and you expect it to last for 20 years, and a lease is giving you the use of that aircraft for 19 of the 20 years, then this is giving you the asset for most of its useful life, and it would be referred to as a finance lease. At the other end of the spectrum, a lease that only gives you a year's use on an aircraft would be referred to as a short-term lease agreement or an operating lease. And it's very important that you understand that operating leases are short-term and that finance leases are simply a source of finance and they give you the use of the asset for most of its useful life. Questions will use those two terms and you mustn't confuse them. Before we look at the numbers, let's just discuss the main features of operating and finance leases. And to remind you again, discussion areas are very important, particularly in this chapter. An operating lease is a simple, short-term rental of assets. And it means you don't have to buy them outright, so you save the capital outlay, and also if you don't need the asset for very long, you don't want to buy it, use it, and then have to sell it again. By only tying into a short-term agreement, if technology changes, you're not exposed to the risk of technical obsolescence, because your lease agreement doesn't tie you in for very long, and then when you take out a new lease agreement, it can be on a more up-to-date version of that asset. The lessor, who's rented the asset to you, who's leased the asset to you, are generally responsible for maintaining it and insuring it, and that takes away a lot of risk. With an operating lease, you don't have the risk of ownership. And if you continually renew operating leases, you can use an asset for the long term, but on your balance sheet you're only showing short-term debt. Because of these advantages, operating leases tend to be relatively expensive. Before we move on to look at finance leases, let's just consider what sort of assets are suited to an operating lease. Lombard are a UK asset finance company, and one of the types of asset finance that they provide is an operating lease. On their website, these are the types of asset that they would expect an operating lease to be used for. Buses, heavy goods vehicles, plant and machinery, IT. So we can say that assets that are very high in value and perhaps also prone to technological change would be particularly suited to operating leases. Okay, so now turning our attention to a finance lease. A finance lease is very different because it's tying you in to the useful life of the asset. So there's no benefit in terms of removing the risk of obsolescence, and normally there are no maintenance or insurance services provided by the lessor. And it's not off-balance sheet finance because it's a long-term liability. So it carries none of the advantages of the operating lease, except that you don't have to buy the asset in the first place. So if you're a small to medium-sized company without many assets to offer as security for a loan, or perhaps with a poor credit record, or perhaps with directors who can't offer personal guarantees that a bank might require, then you won't be able to get a bank loan to buy an asset, and a finance lease might offer you the chance to acquire key assets that the business needs, and so there's simply an alternative, a much more available source of finance than a bank loan. But in addition to that, a finance lease might be cheaper than a bank loan, and we'll look at this issue over the page. Finance leases may be cheaper than bank loans if you have a situation where a big leasing company is buying assets such as aircraft or company cars in bulk directly from the manufacturer. And by doing so, they may be getting bulk purchase discounts that a small company simply couldn't obtain. The rental company can then simply rent these assets to a small to medium-sized enterprise at a price that is mutually beneficial. A finance lease may also be cheap because the leasing company can borrow at a lower rate of interest than a small to medium-sized enterprise can. So the leasing company can take out a cheap loan and use it to acquire the assets, and then rent the assets over the long term to small to medium-sized companies, again at a rate that's mutually beneficial. Although finance leases and operating leases are very different from each other, they share some benefits. First of all, availability. You can generally get some form of lease, even when a bank loan is very difficult to obtain for the reasons we've already discussed. It might also be the case that you don't want to take out a loan and to buy the asset because you can't use capital allowances, perhaps because you're a loss-making company. Well, if you get a bank's leasing division to buy those assets and to use the tax benefit from those capital allowances, they can pass some of the benefits on to you in the form of a lower lease payment. And finally, loans in general attract covenants. If you take out a loan, you're going to have to promise perhaps not to pay dividends or to keep your gearing beneath a certain level. Those sorts of restrictions don't tend to apply to leases. Okay, now let's start to have a look at some of the potential numerical areas. We'll run through a couple of examples in a minute, but let's start off by talking about the principles. In principle, the cost of leasing can be clearly outlined in terms of what you're going to have to pay as the lease, and also, and perhaps slightly less obvious, the capital allowances that you're not getting because you've chosen not to purchase the asset outright. And also, if you purchase the asset outright, eventually, when you scrap the asset, you'll get some scrap revenue. So you could outline the cost of leasing as the payments, the lost tax saved from capital allowances, and the lost scrap revenue. You could then think about the benefits of leasing. The benefits of leasing are going to be that you're not borrowing to buy the asset. So the benefits will be the savings on loan repayments. As we'll demonstrate in the lecture example that's just coming up, one way of approximating these is just to look at the size of the loan that you would have taken out, the present value of the loan. So we could assess the potential benefits of leasing by looking at the costs and the benefits, netting off each year and discounting. When we discount leasing cash flows, we're going to discount them at quite a low cost of capital, a cost of debt, post-tax cost of debt. Sometimes when you discount projects, you use a high cost of capital because shareholders will expect a high return to compensate for risk. Project cash flows can be very risky. But the cash flows in step 1 and step 2 will be known with almost complete certainty, and that's why we discount using quite a low cost of capital. And finally, after discounting, we'll look at the NPV. If the NPV is positive, then the lease is attractive. In other words, it's cheaper than a loan. That four-step approach will be illustrated using some numbers in a moment. Another way that we could approach this analysis is just to look at the NPV of a loan and to identify all of the cash flows that relate to a loan, and then compare to the NPV of making lease payments and see which NPV is more attractive. So to work out the cost of the loan and the cost of the lease separately, instead of bundling all the cash flows together as we did in paragraph 2.4. Sometimes exam questions will tell you to use this approach. When you're using it, you should bear in mind that the cost of the loan will simply be the amount of the loan that you've taken out, and you do not have to work out the interest repayments and discount them. If you did, for example, if you took the repayments on a loan of 10,000 and discounted the repayments at 10% interest, you'd come back to the present value of the loan. We'll illustrate this in the next lecture example. In lecture example 1, the first requirement is to evaluate a lease from the viewpoint of a lessee, the person paying the lease payments, and to compare the lease to buying the trucks outright, buying an asset outright with a loan. Now this is the most common form of leasing question. We're going to go through it first of all with a simplified approach to the tax treatment of leases, and then we'll look at more complicated tax treatments a little bit later. So in this lecture example, we have made a decision already to purchase some assets, and here it's some rail trucks. Each new truck, if we bought it, would cost €12,000 and has a 5-year life and a €2,000 scrap value. If we buy it, we'll get writing down allowances. Now we're told that we can finance these trucks with the bank loan, which pre-tax costs 7.143%. Now, as you'll know from the previous chapter, whenever you pay interest, you get tax relief. And in this example, tax relief is at 30%. So if we used a loan to buy these trucks, it would cost us 7.143% before tax, so that's 5% after tax, multiplying by 1 minus 0.3. So the alternative to buying these trucks outright is to make lease payments, 5 payments of €2,500. And these payments are made at the beginning of each year in this example. In other examples, they'll be in arrears. You'll just have to read the question. So let's have a look at how we can evaluate this. First of all, we'll go through the simplified treatment of doing 2 NPVs, one being an NPV for the purchase and the other an NPV for the lease, and we'll see which costs less. Okay, so the first thing that we're going to do is to look at the cost of buying these assets with a loan. Now, as we mentioned briefly before the example, the actual repayments of this loan don't need to be calculated, and they're not actually relevant. And I just want to address that issue and to show you that they're not relevant. So here, let's look at the actual repayments. The repayments are at 7.143%. 7.143% of 12,000 will be €857 of interest repaid every year for 5 years. So that's time periods 1 to 5. And then at the end of 5 years, you're going to repay the actual capital, which will be 12,000. The company would get tax relief on the interest payments, here at 30%. So these would be the actual cash flows. For 5 years, you'd have a net cash outflow of 600, and then in the 5th year, 12,000 as you repay the loan. Now the cost of the debt is 5%, as we've said before, and if we discount at 5%, we can work out the present value. And so we can see that we'll come back to a present value of 12,000. It would save a lot of time in the exam if, instead of working out the loan repayments and discounting them like this, you simply said, we're taking out a loan today and it costs 12,000 because that's the amount of the loan today, and that's the approach that we are going to take. So in the exam, don't waste time by working out the precise loan repayments and discounting them. Just accept that the amount that you borrow is the cost of the loan. Okay, so we can now set up a pro forma to do an NPV, and we're just going to drop in the amount of the loan just as a time zero value, because as we've just said, we're not going to worry about the interest payments, and we'll drop in the disposal value, and then pretty much we're ready to go. There's just one thing that we haven't factored in, and that is that if we buy the asset, we're going to get the writing down allowance. So we need to do some workings to show the amount of the writing down allowance and then the tax saved as a result. Okay, let's look at the capital allowances. The first capital allowance will be 25% of the asset value of 12,000. So that will be 3,000, and we'll claim it at the end of the first year, time 1. And then once you've got the first writing down allowance, because this is a 25% reducing balance, you can multiply the first one by 0.75, that's a 25% reduction, and you're going to use that technique to get the next couple of years as well. So time 3 will be 2,250 times 0.75, and the time 4 capital allowance will be 1,688 times 0.75. In the final year, there'll be a balancing allowance. Here you've bought the asset for 12,000 and it's got a scrap value of 2,000, which means that during the asset's life you're entitled to claim the 12,000 less the 2,000 in capital allowances. If you add up the 4 allowances that you have just claimed, the 3,000, the 2,250, the 1,688 and 1,266, they come to 8,204, which means that there's a balance in the final year of 1,796 that you're entitled to claim. On my Excel spreadsheet, that's been rounded to 1,797, which we're not going to worry about. The capital allowances are going to reduce your taxable profit, and it will allow you to save 30% tax in this example. So we're going to take the capital allowances in each year and multiply them by 0.3. So that's going to be a tax saving of 900 at time 1, and then using a similar method, multiplying by 0.3, we'll get the remaining tax savings. And we're now going to take these and put them back into the NPV, and then we can work out the NPV by taking the cash flow, multiplying by the discount factor at 5%, and we can work out the present values. If we add up all the present values, they give us a negative figure, and it just tells us how much it costs to buy this asset. So the cost of buying the asset with the bank loan is 7792, and once we've got that NPV, we can compare it to the NPV of the lease, and we'll move on to that now. The lease cash flows are more straightforward. You've got 5 payments. They're in advance, so they start at time 0, the beginning of the first year, and they end at time 4, which is the beginning of the 5th year. These payments are made at the end of the year, at the beginning of the year, but we put a tax return in at the end of the year. So our first lease payment of 2,500 will give us a tax saving at time 1, 30% of 2,500, and so on. The time 1 lease payment will give us a tax saving at time 2. Netting off the cash flows and discounting at 5%, this time will give us an NPV of 8,118. The cost of leasing is therefore higher than the cost of buying with the bank loan. And we can say that leasing is 326 more expensive. That's the difference between the two NPVs. Now there's another way of presenting exactly the same analysis, and we'll look at this now. This technique will give exactly the same answer, but it's just one NPV. And in the NPV we look at the cost of leasing, and we know these costs already. However, an additional cost of leasing will be that we don't get the tax allowances that we would have got if we bought the asset. So we're going to put that in as another cost. And we're also going to acknowledge that because we're leasing, we save the loan at 12,000 at time 0, but we lose the disposal value. Now we've had all of those cash flows before, we just show them separately. We're going to net them off and discount them. And we come to exactly the same conclusion that we came to before, that leasing is unattractive. It's unattractive because it's more expensive. It's more expensive by 326. In many exam questions you can choose which method you want to use. Some exam questions will tell you specifically to work out separately the cost of the lease and the cost of buying with the bank loan. If you're not told which to use, this method has the advantage of being easy to apply sensitivity analysis to, and that's what we're going to move on to in Part B, so we'll stay with this method as we go into Part B. Part B is an example of a sensitivity analysis that's been set in previous exam questions. In Part B, we acknowledge that the lease is currently unattractive, but we try and think what might happen to interest rates that would start to make the lease become commercially attractive. How much would interest rates have to go up by for the lease to become as attractive as the loan? Now, a good way of handling this in the exam would be to try another interest rate. Okay, we know that the interest rate that we're currently using, which is 5% after tax, makes the bank loan more attractive than the lease. So let's try a higher rate. Let's try, for example, 6%. So we're going to redo the analysis at 6%. So using the approach where we have one NPV, this is quicker to do. The cash flows I'm going to show again, but they're unchanged. The only thing that changes is the discount factor. And at the new cost of capital of 6%, the NPV is negative again. So again, the lease is unattractive, but it's unattractive by a very small amount. And now that we have two NPVs, we can do an internal rate of return analysis that will tell us what cost of capital we'd have to use here to give an NPV of 0, which is showing the lease becoming commercially attractive. We've already used the internal rate of return formula in Chapter 6. In the formula, A stands for the lower cost of capital, 5%, and B stands for the higher, which was 6%. And we're just going to drop in the NPVs. So A is 5, NPV A is negative, NPV A minus a negative NPV, it's going to be a negative 326. minus negative 76. So that's an addition of 76 because you're subtracting a negative. Times b minus a, well that's 6 minus 5, so that's multiplying by 1. And that should give you 6.31%. Adding 5 as your last step. That's the post-tax cost of capital at which the lease is commercially attractive. So just to complete this, I'm going to divide by 0.7, so that's dividing by 1 minus t to work out the pre-tax rate. So 6.31 divided by 0.7 gives 9% pre-tax. So we can say the lease will start to become attractive if interest rates go up to 9%. In Part C, we're asked to look at the analysis from the viewpoint of the lessor. Although a full numerical analysis isn't specifically required, it will help our understanding. So let's have a look at how the lessor would perceive this situation. And we're going back now to Part A, where the bank loan is at 7.143% and the other details are as given in the example. Well, the first difference is going to be that the lease is now revenue and will pay tax on it. But those cash flows are exactly the ones that we saw earlier. The lessor will buy the assets and will get the tax savings. And the lessor will also get the disposal value, and we've seen all of those cash flows as well. They're exactly the same as from Part A. So we can net them off and discount them, and it will tell you that the NPV is positive from the lessor's viewpoint. The lessor will make 326 of gain. And as well as showing you what an evaluation would look like from a lessor's viewpoint, it also perhaps suggests that in some situations it would be difficult to agree on a lease payment. Here, the lessor has an NPV of positive 326 to negotiate with, and in Part A we know that the lessee will find the lease too expensive by 326, so it's difficult for them to agree a reduction in the lease payments that is still going to benefit both parties. The lessor only has 326 to give away. And that's really here just to make the point that leasing works in reality because the lessor can buy the asset for less than 12,000 because they're buying it in bulk, or that they've got a low cost of capital. And those are the two main things that drive a situation where the lessor has a very powerful benefit to buy the asset and to lease it out, and at the same time the lessee can benefit from the arrangement. In this example, it's very difficult for them both to agree a lease that's going to benefit both parties, but in reality it's different because the lessor can often buy the asset for less than the lessee can. That completes the example. There's one extra issue that we need to deal with, and this is that in some countries you can't get full tax relief on the full amount paid on a finance lease. Instead, the tax treatment is slightly different. The tax treatment of a finance lease is that you have to identify the depreciation element of the lease payment and the interest element of the lease payment. And you need to identify those elements of the lease payment because you get tax relief on those elements. So where this sort of tax treatment is specified in a question, and it has been specified in recent exam questions, then you need to be able to do this split and to identify the correct tax impact of the finance lease. And this is what we're going to do in the final example. In this lecture example, we're looking at a company that's made the decision to lease already, and it's going to be paying €2,500 per year in arrears over 6 years. We're then told the cost of borrowing, so we can immediately say what that is post-tax, multiplying it through by 1 minus t. The post-tax cost of debt is approximately 5%. We're then told the tax treatment of the finance lease. That makes it different from the lecture examples that we've looked at so far. And we'll work through Part A together, working out the post-tax cost of leasing on these new tax rules. Okay, so we can put in the lease payments into a discounted cash flow pro forma, and we can set up some space to put in the tax saving on depreciation, but we'll show a working for that, and also the tax saved on the interest implicit in the lease. So let's go into our workings now. We're told that the acquisition cost of the asset is €12,000 and it has 6-year life with no scrap value. So the depreciation implicit in the lease payment is €2,000 per year. You'll get tax relief on that at 30%. So 2,000 times 0.3 is 600 per year of tax relief, and we can put that into our workings. Next we have to work out the implicit interest in the lease payments, and we'll show another working for this. To work out the tax relief on the interest, as a first step we have to work out the interest payments. Now we know that we've made 6 payments of 2,500 in the lease to buy an asset that was worth 12,000. So the total interest that had been paid we can say is 3,000. That's in total. We now have to apportion it to each of the years. Now a simple way of doing this is to use the sum of the digits method. The sum of the digits method gives you an approximate way of calculating the interest. It's not 100% accurate, but 100% accuracy takes a lot of time here. So we would recommend that you use this method, and it has been used in CIMA's own solutions. To use this shortcut method, you look at the number of years, which here is 6, and then you add up, going down to 1, 6 plus 5 plus 4 plus 3 plus 2 plus 1, and if you add up all of the digits, that's 21 years. We can then take the total interest paid of 3,000, and we can say that 6 being the first digit of the 21 being the sum of the digits of the total interest payment belongs to year 1, and that gives me 857. For year 2 it will be 3,000 times 5 being the second digit over 21, which gives me 714, and then it's 3,000 times 4 21sts, 3 over 21, 2 over 21, and finally 1 over 21. So 3,000 multiplied by those will give me a fairly accurate figure for the interest implicit in the lease. And once I've got the interest payments, I can work out the tax relief, because the tax relief will be 30% of the interest payments. So 30% of 857 is 257, and 30% of the other numbers gives me the figures that are shown. And those are the numbers that go into the NPV, and then we're just going to sum the numbers together and do our normal discounting. And so now if we put in the tax relief on the interest payments, add up the cash flows and discount at 5%, then we're saying that the NPV of the lease with these revised tax rules is 8852. Now I'd like you to pause the presentation there and have a go at part B, which returns you to the simplified tax rules that we looked at before. In other words, assuming that you get tax relief on the full lease payments again. So allowing a simple 30% tax relief on the full lease payment, discounting at 5% over 6 years, gives you a present value of 8883. And this value of 8883 is slightly higher than the previous value of 8852, because in the previous approach we've front-loaded our tax savings. There were more in the early years than in the later years, whereas with this approach the tax savings are equal in all years. So the method that we've used in Part A gives us a slightly more favourable outcome. To finish the chapter, we're going to briefly look at the benefits of leasing to the lessor. The lessor will be receiving the lease as income. Banks can raise finance fairly cheaply and buy assets using fairly cheap capital that many companies won't have access to. They can use that cheap capital to buy assets and then lease them out on commercial terms. Companies, car manufacturers, aircraft manufacturers, computer manufacturers will seek to boost their sales by offering leases on attractive terms to attract customers. And finally, not particularly important point, but if you're a profitable company and you set up a leasing subsidiary, you can buy assets, and as you buy the assets you'll have capital allowances that you can use to reduce the group's taxable profit. Leasing can also be used to raise finance. For a company like Tesco, if you've got lots of valuable property, you can sell the property to a landlord and lease it back from them. Tesco did this in 2009 when they sold £514 million of their property and leased it back. In the future, they may well live to regret this if the lease payments go up. But for now, it's given them an important strategic advantage and it has allowed them to continue to invest heavily overseas. Leasing is a very important area. It's extremely important that you can discuss the pros and cons of different sorts of leasing and that you're comfortable with questions. There's a useful question in the question bank at the back of your course notes that you should certainly attempt.